This might sound crazy, but you and I probably have more assets in our personal names than the richest people in the world. And it's not that they don't own anything, they just own in a different way. They care more about control than personal ownership. Because when everything is in your name, one messy life event can put years of hard work at risk. So in this video, I'll show you why rich people basically own nothing, and I'll give you a few practical moves you can do today, even if you're just getting started. But first, let me show you why wealthy people are basically allergic to personal ownership. Most people only discover about asset protection after something has already gone wrong. And by then, it's like trying to buy home insurance while the kitchen is on fire. Here's a simple example. Imagine two people who both own a rental property. Person A owns the property personally in their own name. Person B holds the property through a separate structure, such as a company, set up specifically for that property. Now imagine the tenant has an accident and decides to make a claim. For person A, that claim goes against them personally, so it can feel like their entire financial life is on the table. For person B, however, the claim is limited to the company structure. And this is where the limited liability concept comes from, but I'll cover this in more detail later in the video. The core idea isn't that person B becomes magically untouchable just because he has a company. The idea is that company structure can stop one hit from automatically spreading to everything else, and that's exactly what wealthy people do. But asset protection matters even if you're not a millionaire. Imagine a guy called Gary. He's in his 50s, has worked hard, and has gradually built up a good life for himself. He owns his main home, he's got a rental property, some investments, a decent cash buffer, and a couple of nice cars because, to be fair, he's earned it. And like most of us, Gary holds everything in his own name, because that is what most of us are told, isn't it? If it's in my name, I own it, and that means security. But one day, Gary is driving home. He has a moment of bad judgment, looks down for a second, and causes an accident. Someone gets injured and decides to speak to a solicitor. And suddenly, Gary learns a lesson nobody ever bothered teaching us at school. When there is a potential legal claim, it's not only about who was at fault, it's also, is this worth pursuing for more than insurance claim, for example? Because legal action takes time and money, and lawyers want to know whether there is a realistic chance of recovery at the end of it. And that is where Gary's setup starts to become a problem, because Gary looks like someone with money sitting in plain sight. Now, I'm not saying genuinely injured people shouldn't get compensation. Of course they should, but sometimes you also get opportunities. And when everything is in your name, all your hard-earned assets are on the table. And this is why wealthy people tend to prioritize control over personal ownership. They would often rather control a company that owns an asset than own the asset personally. Why? Because control can spread risk, while personal ownership usually concentrates it. So now that you've got the mindset, let's make this practical. I'm going to walk you through a simple ladder, starting with 3 steps that almost everyone can take today, and then gradually moving into some more advanced structures as your assets, responsibilities, and risks grow. That way, you're not trying to figure it all out in the middle of a crisis, like Gary, who only wanted to drive home and now has accidentally become an educational example. Making your assets less visible doesn't always mean hiring a team of lawyers and building complicated structures. At its core, it really comes down to 2 things working together: asset protection and privacy. Asset protection is what helps when something actually hits you, like claims, disputes, business issues, the usual fun stuff. Privacy is what stops you being the easiest person to target in the first place. Think of it like a bulletproof vest and a camouflage jacket. The vest helps reduce the damage once trouble has already started, and the camouflage makes you less likely to be spotted as the easiest option to go after. Put them together and you're simply harder to mess with. And just to be clear, the goal here is not to become untouchable. Even the best setup doesn't make you completely invisible to HMRC or the courts. The goal is simply to be in a much better position than Gary, where one bad event does not drag your entire life into the chaos. Now, this works like a ladder, because as your assets grow, your exposure usually grows too. More assets often means more risk, more visibility, and a greater need for proper structure. That is why we're keeping this to 5 progressive levels you can follow to make your assets less visible and better protected over time. The first 2 levels are mostly privacy and organization. In other words, this is where you put on the camouflage jacket, and the later levels become more advanced because that is where we start introducing structures that can do a better job of actually protecting assets, not just making you harder to map out. So the core idea is simple. First, become harder to spot, then become harder to hurt. At level 1, a free and simple way to make yourself a little harder to find is to shred sensitive paperwork. Putting your bank statement or an HMRC letter straight into the bin is not a brilliant idea. There are people who will literally go through household waste looking for personal information, which is both unsettling and, frankly, a very odd activity. But there are people like this. In fact, 20,000 people in the UK had their identities stolen in 2024 from personal information they had thrown into the household waste. A small shredder next to your desk solves this problem nicely, and it can be a little bit fun too. If you do not have one, another option is to just soak the papers in water and turn them into pulp until they're completely unreadable. The second thing to do is just Google yourself. Seriously, I mean, if you have never searched your own name before, there is always a chance you will discover far more about yourself than you ever intended. Unfortunately, Google has a free results about you tool that helps you check whether personal contact information like your home address, phone number or email address appears in search results. And if it does, you can request removal of eligible results. You can't remove everything, but you can remove some things. And if you're a company director, it is also worth checking what appears on company's house. It might take a little bit of effort to do all of this, but that is really the point. If you want to be harder to find, you first need to know what information about you is already out there. At level 2, there are a few extra steps you can take that involve a little bit more time and a bit of money. And one example is using a virtual office address service if you run a limited company. Not to hide from HMRC or to dodge anything, it's simply because your home address does not need to be floating around online for anyone with Wi-Fi, curiosity and far too much free time, because your address gets posted on the company's house register. You can find virtual office providers for as low as £30 a year, so it won't cost you much, but the benefit is significant. Another big part of level 2 is checking your insurance cover properly. Wealthy people tend to love insurance, not because it's exciting, but because when something goes wrong, insurance can often absorb most of the damage, so your assets don't have to. And in the real world, when a problem shows up, the first question often is not what structures do you have in place, it is what insurance cover do you actually have. And a weak policy can undo even the fanciest structure surprisingly quickly. So it is worth checking things like, does your vehicle insurance include personal cover? And if you earn money from advice or professional work, do you have professional indemnity insurance? What exactly does your home insurance cover? And just as importantly, what does it not cover? You know, it's not the most glamorous topic in the world. You know, nobody is showing off their insurance policy at a Royal Ascot meet up with their mates. But it can be the difference between an annoying situation and a sell assets and panic situation. That is why level 2 is really about adding a few sensible layers of privacy and protection before problems ever show up. At level 3, this is where wealth protection starts to look a bit more serious, because we're talking about opening a limited company, which we alluded to earlier with the property example we gave. In the UK, a company is its own separate legal person, which sounds dramatic, but all it really means is this. The company can carry out the trading activity, and it can also own legitimate business assets in its own name. So instead of everything valuable sitting under your personal name, some of it sits inside a separate legal entity. And that changes the level of risk you're personally exposed to. Now, before anyone gets too excited, there are two very common ways people accidentally break that protection. The first is not taking your responsibility as a company director seriously. In other words, not running the company properly. That usually looks like this: no separate business bank account, messy bookkeeping that doesn't make sense, missing receipts, no payroll records, no dividend vouchers or director's minutes. In other words, if you don't respect your limited company, don't expect the court to respect it. If the courts decide there is not a proper separation between you and the company, they can pierce through the corporate veil, which what it means in plain English is that if legal action is taken against the company, the structure may no longer protect you personally. So that's why lesson number one is respect your LTD. The second big issue is personal guarantees. This usually happens when your company goes to the bank for a loan, for example, and the bank says, sure, no problem, as long as you personally promise to pay us back if the company cannot. And if you sign a personal guarantee, even the best company structure in the world cannot magically protect you from that liability. But the most important part of level 3 is knowing when it actually makes sense to move to this level, because this is the time you're moving into a more formal structure, usually from a sole trader, and some people don't always understand the responsibility that comes with it. I go into much more detail in the video linked here about when you should consider making the switch to an LTD, so I will not repeat all of that again here, but the real benefit of setting up a company structure is not that you suddenly become untouchable, it's that you create a better separation, better control, and stronger foundation for protecting what you're building, provided you respect the structure and make sensible decisions. Level 4 is the next mindset shift. Even if you have an LTD, don't throw everything into the same basket. Because if you mix day-to-day trading risk, where you deal with customers, sign contracts and hire staff, if you mix this with all your valuable assets, you've basically rebuilt Gary, but in a company. The wealthy tend to spread risk a bit more strategically. This is why you often see one company doing the trading and bringing in the income, another company holding properties, sometimes separate entities for different projects, and even a separate company holding intellectual property. And it's the same principle as before. Although you do not personally own the assets held by those companies, you control the shareholdings in them. So the control stays with you, while the risk is spread more sensibly. A structure like this can also make it much easier to reinvest profits and build wealth over time. If the trading company generates profits, you can put systems in place to move money into other parts of the group structure for future investments and projects, rather than always having to take out money personally and paying up to 45% tax on that. That said, this level only really becomes relevant when the scale justifies it. If you're just getting started, there is no need to build a mini corporate empire yet. For most people, the basics covered in the first 3 levels will be more than enough to get you started. Level 4 is not about looking sophisticated, it's about creating the right structure when there is actually something worth protecting, separating, and reinvesting. Level 5 is where the planning gets a bit more advanced. This is the stage where you may want to make certain assets less visible or more protected in specific life situations. The obvious examples are things like serious illness or divorce. Not exactly cheerful dinner table topics, but very real ones. This is where trusts often come into the conversation. People with assets often use trusts to create a bit more structure around things they want to pass down, such as property, investments, or family wealth, so those assets are more likely to end up with the people they were actually intended for. Now, to be clear, trusts are not some magical invisible shield. Courts can and do take a very close look at them, especially in situations involving divorce or adult social care funding. So this is not a bulletproof hide everything and ride off into the sunset strategy. What it is though, is one of the long-term tools wealthier families often use when they're thinking ahead. And one of the biggest misconceptions here is that you need to be a millionaire before any of this becomes relevant for you. You don't have to. The real advantage wealthy people often have is time. They plan earlier, they make decisions while everything is calm and it can be planned for. And they get proper advice while there is still time to do things properly, so the structure has a much better chance of standing up when it's actually tested. Because once a claim has appeared, or creditors are already starting to circle around like seagulls around chips, suddenly moving assets around can create a whole new set of legal problems. That's why protection is something you build in peacetime, not while the building is on fire. So this is the ladder. Start with the 3 steps that make you less easy to target, then put basic privacy and protection in place, then add structure when it makes sense, then ring fence assets when the risks get bigger, and finally use long-term tools when you're thinking decades, not months. So now you understand how to make your assets invisible, or at least less exposed, and you've got a few practical moves you can do today. But the problem is, if you don't structure things properly, or you don't know where to start, you're still exposed. So watch this video next, where I break down the structure rich people use and how you can copy it too.